And that's the pros and cons of opening up the marketplace and getting out of just sticking with the mainstream, big four lenders, where you're limited in what you could do. Then suddenly all these extra players coming in and finding different ways to obtain finance and getting it from overseas, bond markets from overseas, and attracting new money in, and they weren't under the same regulation as the big banks, so they could just go wild, and the banks didn't like it. They didn't like that kind of competition, and that's where the pressure really started to become, hang on, we want to compete fairly, help us out, and what do you know, things start to change.
You're listening to Property Investor Tales, stories from the front yard. Here's your host, Tabitha Bright.
Hello and welcome to Property Investor Tales, stories from the front yard, where I get to speak to property investors from around Australia about their investing journey. My name's Tabitha Bright and I'm head of coaching here at Positive Real Estate, where we help people build wealth through property. With over 8,000 clients across Australia and New Zealand, there are some incredible stories to tell, which hopefully make your investing journey that little bit easier and will inspire you along the way. So my guest today is Scott McLean, and we discuss why getting a cheap interest rate may not always serve you, and why selecting a broker that understands building a property portfolio is critical to your success and outside of the norm. So enjoy this conversation with Scott. Hey everyone, Tab here, head of coaching, Tabitha Bright, head of coaching, Positive Real Estate, with our next episode of the podcast. So today I have our head of finance, Scott McLean, finance expert extraordinaire. He's done 23 years in finance, and he heads up our team here at Positive Real Estate, part of our 6-star team of professionals and experts, part of who you need in your team when we're looking to build our investing career. So Scott, welcome to the podcast.
Thanks, Tab. Really looking forward to it. Very excited. 23 years is a bit embarrassing. Surely I'm not that old, but really looking forward to it, Tab, and great to be part of it.
Wonderful. So I like to interview some of our internal teams, so you guys get a bit of an inside look at the team, what they do, why it's important, and some stories. Because over the years, like I've been investing since my 20s. Scott, I'm a bit older than you. I think. Can we ask your age? Is that rude?
No, you can ask.
Doesn't mean I'll tell you.
No, I'm 49.
Right, so I am. I'm close to half a decade older than you, so I can claim some seniority.
Okay.
And that alone. But where I was going with that, I've been investing since my 20s. Scott, you're probably similar. You've had the long-standing finance career. And so over that time, both Scott and I have seen the finance world change incredibly, not only due to technology, but, due to market pressures, GFCs, you name it. And I remember, I don't know about you, Scott, the days when no doc and low doc loans were around.
Yes, I remember, Tab. We were very popular all of a sudden, very popular when they came about.
And they were awesome. I remember literally, and I hope I'm not incriminating myself here, I remember like literally getting a bit of paper. I had a company I was investing with, a company trust. I'd write down what I predicted my income was going to be, and I'd include the capital growth I was projecting across my portfolio. I'd write that number down, and then I'd be able to get lending on it. It was as simple as that. Oh, how times have changed.
Oh, how times have changed. And I wonder if that process had anything to do with why things had to change.
Maybe. And remember asset lending. Like you just literally go, here's an asset. I can put, 70%, 30% in deposit. Will you lend?
Yeah. Sure. Why not?
Like, woohoo.
Yeah.
Didn't have to have income. Yeah.
It was very rare to get people to say no back then. It was like horrific to say no because everyone was looking for a reason to say yes.
And one last memory from me. Do you remember the Equity Mate ads from CBA?
Oh, yeah.
And I don't know if any of you guys remember that, but I think it was CBA, and they had these ads running on the telly, and it was, if you got equity in your home, come talk to us. Equity, how did you buy your boat? Equity Mate. It was prolific, right? Yep, they couldn't give money away.
Oh, it was crazy. I mean, you haven't mentioned either. What about the 120% LVRs? That were going on. That you actually could borrow more than the asset value. 110, 120. When it really got right up there pre-GFC.
Yeah,
that was crazy. Crazy
you didn't
back
have
then.
to have a deposit. You just.
You got more than what the asset was worth. So it was some interesting competitive ways, and that's the pros and cons of opening up the marketplace and getting out of just sticking with the mainstream, big four lenders where you're limited in what you could do. Then suddenly all these extra players coming in and finding different ways to obtain finance and getting it from overseas, bond markets from overseas, and attracting new money in and they weren't under the same regulation as the big banks, so they could just go wild, and the banks didn't like it. They didn't like that kind of competition, and that's where the pressure really started to become, hang on, we want to compete fairly, help us out, and what do you know, things start to change.
And remember when they just about wiped out the broking world? Do you remember they, with the Royal Commission, and they made it. Yeah.
Do I remember? My goodness, do I remember? It was a very interesting moment in the world, really, because there were many other markets that still to this day, New Zealand's one of them, that looks at Australia and goes, how come the Australian broker market is one of the only markets in the world that get paid a recurring or a trail commission or a loan book commission, as long as that loan is staying with that lender? And the jealousy from overseas is crazy. But the flip side is the lenders are saying, that's a good point. Why can't we get rid of it and then only pay an upfront commission just like the rest of the world? What we saw is that the marketplace, with not just the number of brokers and the big broking groups out there, were able to put enough pressure, and customers were saying, hang on, no, we don't want to get rid of brokers. And one of the reasons is because of that revenue stability from the Trading Commission. We saw with the pandemic as a prime example of one of the rare businesses in the marketplace, in the economy, that was able, when upfront business was coming down because of the lockdowns and so forth, businesses, small businesses, people's homes and things like that were able to still have revenue coming in to the household because of a recurring trail commission. So stability-wise, it stabilised an economy when it really needed a hand from somewhere, So there are other intrinsic values which have sort of justified it. But it's a very unique experience, how it's been targeted by banks still.
Yeah, I remember there were a lot of petitions going around because from our point of view as an investor, the benefit to having a broker, and I got Scott to give me the definition of a broker because I wanted to make sure I was using the right terminology, because sometimes, we can tweak terminology or use it when it's not 100% accurate. So, a broker is basically somebody that's writing your loan that has independent access to multiple lending options. You're not just going directly to, obviously, the lender. And that is important for us for a number of factors. As investors, there's a few key things we want to avoid, right, Scott? We want to avoid cross-securitization. There's the all monies clause. We want to have access to multiple lenders because they all service your situation differently.
Correct.
So tell me a little bit about that. Like, what are the variations in the market? Because it can be massive, can't it? The rate that they put on top, and take me through some of that.
So extreme. It's quite bizarre. And the change and how it can happen is so fast.
Yeah.
And quite literally, you think of any business and the market forces that exist. I'm just going to talk some basic ones first, for example.
Yeah.
One is the most common thing everyone talks about with lending is the interest rate. That's the one topical item that makes the news and so forth.
Yeah.
So lenders are acutely aware that if they have a lower interest rate, that usually attracts business.
Yeah.
And then they'll find there's a price point where, if we've set the interest rate too low, we have a tsunami of customers coming at us.
Okay.
And then they have to make a decision and go, okay, we don't have enough staff to actually team members to process that volume of business coming through. So therefore, what lever can we tweak to actually slow that down? And suddenly behind the scenes, they might go, to get that interest rate, what you might do, you now have to have a 40% deposit, for example. So you have to have a 60% LVR, loan to value ratio, to be able to get that interest rate. And that's their way of covering off, especially if it's in the media or on TV or social media. That way they can allowed to keep it and not have it as misleading information, which there's been a lot of smacks over the wrists over the years.
Yes.
But that's one lever right there. And that could be a mainstream lender that today they go, look at that rate. Yep. Or cash back $5,000. You go, bringo, let's go there. We want $5,000 cash as well. And then you walk over and then you find it, but basically you need to be earning this amount of, extreme amount of dollars, or the LVR has to be really low, or you have to bring your business banking over. There's all these things that aren't in the televised or, asterisk scenario to get those scenarios. So, and the other, debt to income ratio is the most famous new lever that's been turned up over the last 12, 18 months in particular.
Yeah. So
debt to income ratio. Yeah, debt to income ratio. And you'll see lenders and economists start to talk about that more and more. They just want to make sure it doesn't get out of control. That if the debt to income ratio is too wide, they go, no, too tight, we're too high risk, more likely something to go wrong if something changes.
Yeah.
And they'll pull back. So that's a couple of levers just there in itself that can be the difference on what looks like a good rate, but you might not be able to qualify for it. And same, whether it be loan to value ratio or the ratio to your income. And then when I say income too, Tab, this is the other thing. It's what you can substantiate is the other challenge that a lot of people realize too, that you might know, especially as a self-employed person, I can get my revenue here, but you've got some other mechanisms in place for perhaps some tax strategies that are going on, and therefore that then goes against how you're trying to say how much income's available. So there's some things like that the lenders will have in their pocket to then drill down a bit harder to not allow as much flexibility, even though you've got good incomes coming through, your house, business, things are stable. But there's ways to then sort of put you back and make you feel like, oh, geez, I'm just lucky to be here. And that's some of the language they can use sometimes.
Yeah, and there's some sort of key rules to investing, like where you can keep your look at using different lenders, just to give you a little bit of a safety net around cross securitization, because tell us a little bit about cross securitization. I mean, essentially it's where the lender will just put all of your properties into one big bucket, so to speak. And there's a loan amount that is across all the portfolio. You have a certain LVR, so a certain debt to the value of the properties. But then if two of the properties go down in value and one of them goes up and you want to get the equity out of that one, then you may have a challenge, right? Because the overall portfolio.
Correct. So there's pros and cons. There's a time and place when cross securitization is the only option available to keep it all together. But then if you're someone that's looking at changing and updating regularly, then you're like, oh, last thing we want to do, because to undo it is quite messy, or can be quite messy. So I got a scenario that, you know, at the moment where there's someone's cross-collateralized, they've bought an investment property, they've put their mother in it, who's not retired yet, but she's mid-70s, very close, probably imminent to the retirement. And they're in a situation where their owner-occupier house was in a place that had not a good neighbour, let's just put it that way. So they wanted to get out and leave. Now, in the process of doing that, they can't just sell and then get out so easily, because both properties are connected,
are locked together.
That's right. And because they used equity from the owner occupier to get it, the lender said, well, if you want to keep that other one, you now need to pay us
and pay that debt down.
And get that LVR to the place where we'd be comfortable with it in isolation. So they thought, we've made a profit on our own occupied, sold it for 620. And I can't remember if it was like 500s or somewhere where they originally bought it from. So they're thinking, oh, here's 120 grand I can use to the next. They go, no, we need 90 of it to go to this other property.
Yeah, so you don't control your equity basically when you're cross-secured. When you've got a much lower LVR, so when your loans are all paid off, then, you know, sometimes it's a strategy if you need some deposit funds. It doesn't help servicing though, does it, when you're cross-secured?
No, not necessarily. It's more about the bank just wants to feel safe that if the ability to repay, is there enough equity there to feel comfortable with? And that's all they want. They want that comfort level. And they try and see if there's a high risk scenario in there. And between the two, they look pretty secure, safe. They're okay. They're okay to let it go. But yeah, when it comes to an investment property where people are trying to get a high LVR as they can to minimise or maximise the tax benefits, etc., on the interest, then they're like, whoa, hang on a second. No, we now, because you haven't got that equity because you're removing that security, we need that money to come back in and get the LVR so we're comfortable.
Pay it down. So sometimes you're not in the position you think you're in. To be able to move forward. So that's why when you're in the acquisitions phase of your investing, so the early days, you're still buying the number of properties that you need in order to hold for the long term. And if you are utilizing getting equity back out and all of that stuff, then cross-securing can really slow you down. Later on, it can be a strategy if necessary, but generally speaking, the rules for investing are try to avoid cross-securing. Obviously, everyone's circumstances are different. But this is why, once again, you need a broking team that understand investing to get the best result. Because what I've found in my journey with brokers is a lot of the broking world will focus where the most business is, right? Because it makes sense. Would you agree? And that tends to be around people buying their first home, upgrading their home, maybe buying one property, one investment property, which is often cross-secured. And because that is where the most business is. And then you get people like Scott and his team who specialize in helping people build a portfolio. So they have to understand, they work really closely with the coaching team. They have to understand what a client is trying to achieve. We look at your maximum servicing. And if there's challenges around that, then we work together as a team to find out, well, what are the levers that you guys can pull based on the circumstances that change constantly, right? So how often would lenders update their servicing calculators?
Probably in the last 5 minutes, probably would have been 3. Oh, look, it's very regularly, like incredibly.
It's constant,
it can happen.
Isn't it?
Things change daily. It's that quick. Lenders will typically try to just make sure it meets the criteria on a monthly level when they meet, especially after the RBA meet, and see if there's any things they need to take into consideration. They check the bond market, the price of money at the moment, those things to forecast if they need to slow down or if they need to accelerate, those type of things. So those servicing calculators can change literally daily. And they're only really locked in once you've got an application ready to go. Then the clock starts and you've got a 90-day period to lock in that whatever scenario.
Right. And so once again, you'd want a team that have access to as many lenders as possible, because if every lender is different, then there may be a lender that is more likely to take on your circumstances. So if you're self-employed, if you've got 4 kids, if whatever it is that is the issue, then if you're going direct to the bank, you're going to one lender whose circumstances may or may not be, looking for your type of business. And so this is where we get all the second tier lenders and other people come to the party, right? And so what Scott's team's job is to know all of these lenders and be up to date with their calculators, which lender will suit this client's position. So it's not always about the interest rate.
It's never about the interest rate. Never.
It might be that as an investor, we make a business decision, right, to pay 0.25 more, 0.5 more, because the lender will lend us 200 grand more, that over time will, with capital growth, will give us a far better result with our investing than having scrimped and saved on 0.5% and bought a substandard property because it was a lower price. Yeah.
Tab, if I could give just one example of this scenario, I'm going to use a big 4 bank, and this is not bank bashing because obviously we need them, but just one example of one of the big 4s. I'll just make a random name up, Westpac. Okay. So now, if you're an existing customer, which is fine, and if you've had a loan with them for at least over 12 months, so like 18 months, the price of that money that you had at that point was the cheapest it's been in the history, very low. So in that time, as we know, rates have gone up considerably, effectively, and therefore the price of money if you bought today is higher than what it was a year plus ago. Now, as the banks know that there's a lot of clients that are coming out of fixed rates. They've got them really cheap and they're about to come out, and more coming out next month, February. So that's the big thing. They're coming out of 2%. They're like, oh, how good were we? And now they're going to get the shock of their life as they start to come out and they're seeing a 5, maybe even higher, depending on their circumstances. Now, what's happened in that time? In just the last 2 weeks, the Westpac have increased how they value your expenses, your living expenses. So they have a standard. You've got the HEM that basically has a benchmark of what they think that your living expenses are. That has gone up 28% just like a week or 2 ago. So someone who thought, oh yeah, they see me as a good customer. Yeah, I've got the ratio. I should service comfortably. Within like a week, suddenly 28%. So 4 times inflation, it's gone up. To get an indication that they're trying to slow things down about when you come out or who comes out, about how you qualify all of a sudden.
Right.
So the big thing to take from there, and why you use a broker, because you might have you might have been Westpac all your life and go, oh, I don't want to change anything. That one decision might suddenly make you from what might be servicing comfortably, go, actually, I've got a loan that's coming up or a property I'm about to purchase. You've gone from this is easy to something like, hey, I'm floating. My eyes are just above water. And it doesn't have to be that way. It's just that lender's made a decision to slow things down. Then there'll be another lender that go, we're not putting up the living expenses. We're comfortable at this level.
We need more business.
Correct. Our insurer says we've got a good level ratio of debt and equity in our space. Let's go for it. And their interest rate doesn't have to be too pointy, but it could be close to that cheap rate, but you'll get through much easier and you'll get the outcome. And that's the thing we're trying to tell people. Don't focus on the interest rate because it's a bit of an illusion. there's costs, there's other criteria behind it. Focus on, if it's the property you're after, what do I need to do to get to that property? And the clock starts and what you need to get from it before you move to the next phase. And have a lender that works with you, and make sure the broker absolutely understands with your coach what your strategy is, to make sure you've got a lender that's not going to burn you when you come out the other side, or make changes either. So that was just one example I sort of want to point out.
And penalties if you try to get out of it. Yeah.
Well, that's exactly right.
Massive
Typically,
ones,
when people refinance, for example, within 2 years, lenders get a little bit, we don't like it, because they say we don't make enough money in that first 2 years. So they want people to stay longer than 2, and they'll incentivize to do that. But I mean, some lenders are now putting in they're going to have an increase of 0.1%, decrease in your interest rate by 0.1% over the life of your loan. Which is another, but they'll start the rate up higher
to accommodate that. They're cheeky buggers, aren't they?
It's like they'll say, there's no fees. Come to us because we don't charge you fees. And you're like, yes, I hate fees. Great. If you don't like fees and you go somewhere with no fees, well, the interest rate will be higher because it'll cover it there.
Yeah,
or I'll
so
give you a low interest
there,
rate, but then I'm going to charge the fees over here to.
So it's not always interest rate. And I know a lot of people when they first start investing are very interest rate conscious. And it's not that you don't take that into account, but you have to look at what else is part of that. Like, does the loan come with an offset account that you want? Does it,
That's right.
Yeah.
You'll get those cheap honeymoon rates, they call them. That, look how low that is. I'm all there. And can I get an offset? No. Well, but can I get maybe a redraw then? No. And you're like, what can I do? Just sit, let it forget, and just pay it off over 30 years, and we're happy. And you're like, it doesn't quite work with my strategy. So that's why, interest rate can be a big distraction if you make the wrong decision on that decision.
It can be costly.
Very costly later.
Yeah, interesting. And even with the honeymoon rates, and without teaching all of you guys to suck eggs, because I know you're not daft, but with honeymoon rates, I remember as a young person when I bought my first property, interest rates, I was paying about 13%, I think, as a honeymoon rate. I got 13%, 13.99% honeymoon rate. And it was for 12 months, and the market was, 16% or 17% or something like that. And I know people have seen it higher.
91.
And I remember working my numbers out on being able to afford it at 13%, because that's what I desperately wanted, this property. And I was making an emotional decision. I was young, and I thought I'll work it out when the time comes that it goes up. And it nearly crippled us. And so you have to be aware that the honeymoon rates are only for a short period of time, but you need to look at what does it then go up to, because the bank is going to recoup the lenders, I should say, are going to recoup their costs. Our businesses, we need them. We need them to make a profit. It would be unsustainable to not have that as an option if there were no lenders in the market making profit. However, we want to understand what our risks are and mitigate accordingly and make good decisions around our lending, so that we're not just focusing on what the banks or lenders are going, hey, come over here, this is bright and shiny. Ignore all of this stuff over here.
I think you've just got a lot of credibility, Tab, right there when you just admitted that you had a 13% honeymoon rate. There'll be a lot of, especially baby boomers out here, that tell us all the time, I remember when rates were 17, 18% in 1991. And what are you kids complaining about, but they forget to mention they had $100,000, $200,000 debt, and their kids are now talking about $1 million, first home.
Correct. I think the first property I bought, and I know people I've spoken to people that were buying properties at 10 grand a pop. But going right back. But I think the house I bought was 135,000.
There you go.
And I had a 97% mortgage on that.
Capped LMI, all right?
At 13%. So, it seemed like a lot to me back then. But then, you look at I think I was earning $450 $69 a week, I think, was my wage. I worked for one of the banks. Yeah, and they didn't give me
rate.
special rates back then either.
No, I think
they stopped that.
A lot of credibility, Tab, when you've actually done it, and as a young person as well. I think that's that shows. Sometimes it's just about getting into the marketplace. Just get in. And then you work through it, but work through with people that make sure you've got the finance, which is just doing this job. It's just a leverage item to get you to the next point and to make sure you're not overcommitted, or what do you need to do to actually get obtain that finance in the current marketplace. It's just a slight adjustment, but if I can just elaborate further.
Yeah, please.
Time is everyone's friend. So if you know you got Christmas and things coming up and you're spending and want to go nuts, but you want to purchase or get into the market, the sooner you can show in your spending history is actually very stable. It's not erratic all over the place, consistent. And if you can get not only 1 month, but 3 months looking steady as she goes, the lenders go, we like that client. We don't see a lot of flopping around and erratic spending. So we'll take that as solid and stable type of customer. They love it. So that's just something to think about in that scenario too, as you improve your options, especially if you know something big is coming up, and how you cover that off to make sure you can do that, but then show your consistency and stability, and the lenders will love it. You'll have more options available too.
Yeah, no, that's awesome. And I think too, the good news in all of this is that finance changes so rapidly that if at the moment you are being told no, then make sure that you talk to brokers. When I qualify brokers, like POS Money are fantastic, Positive Money, and thank you.
POS Money.
Yeah, positive. Just our internal lingo. So Positive Money do a fantastic job. I always ask any broker that I look at using, like, what is your experience with people that have 5 or 6 or 10 properties? How much of your loan book does that make up? Have you written loans for people that have multiple properties? Because, if they haven't, and you're trying to get to a place where you're going to have a portfolio with multiple properties, they need to understand how to structure each loan to get you the best result over the long term. And hence our clients tap in largely to our 6-star team and recommended broking teams. So awesome to have you here, Scott. We were going to talk very briefly about some funny stories, but I think we've really covered off the crux of what I wanted to cover. And I think just before I'll let you speak, I'm going to get in really fast. Scott and I are both like talkers.
Allegedly.
So we thought this might take a little while, this podcast. But I would like to say, for those of you that are concerned or stressed that right now you don't service, make sure you get an opinion from what I will call a quality experienced broker. And also, just keep checking in on a regular basis. I would check in every 3 months and get somebody to do your servicing because finance is changing constantly. The third thing I do is find out from your broking team what is getting in the way of you servicing.
Yeah.
Because sometimes it can be something that's relatively small that you might be able to fix, like what Scott said. You might just need 3 months of all your bank statements looking super tidy with minimal spending. And
no missed payments. And no missed payments or anything like that. So it shows that, paying the bills when they come in. There's no red flags. It can be as simple as that. The other thing is, not changing around your job too. If you know you're planning to either change job, then that will impact. If it's in the same industry, same type of role, same industry, then that can be fine. So if you're in the process of about to go ahead, if you turn it over quickly, in other words, I lost my job on the 1st of December, but I was able to be re-employed by the end of December, a lot of them will say, that's fine, that's great. You've jumped into something quickly. So you still look stable because you've been jumping into thing. That big word, stable, is across many things in the marketplace that the lenders are looking at. They just want to see.
They're looking for that now.
That's exactly right. If you know there's change coming, tell your broker. Oh, that's the other thing. Don't hide things that you know that you think might impact your outcome, because the broker is not the judge and jury. What the broker is on your team at trying to find, okay, well, which lenders are okay with the change, or what's the time frame when they will be okay. So they might say 1 month is too soon, but we have lenders that will 3 months, they'll love it. It'll be forgotten about. You're totally fine. There's some lenders that will take 1 day employment in the new job and consider that income.
Yeah.
Now, not many people realise that. If you just go to your same lender that you've always had, they'll say, no, you can't do it. It's too soon. But there are some lenders that will do 1-2 days where you can just show a contract letter and you're away.
Declaration to your broker. Yeah.
Absolutely. So that, like I said, the broker is your friend to find the solution. They're not the judge and passing judgment on you. They're on your team. Give them as much information as they can, good, bad, or ugly, so they know what they're working with, because they'll know which lenders are going to be more favourable, which lenders are in your sweet spot or wheelhouse. Even if it's down to, it might be just 2 lenders, but at least there's 2. All you need is 1.
Yeah, because the last thing you want is declines on your file, right? You don't want to have not given the broker all the information, so they've submitted it somewhere else and then it's come back declined. So then that flags it, doesn't it?
Yeah, that's right. I mean, the lender wants to see they can trust the broker as well. So if you're not telling the broker information and they put you forward, remember they're like your PR team. So they're putting you forward to go, listen, Mr. and Mrs. Lender, this is why you're going to like this client, Tabitha, for this reason. She's great for this reason. Look at the funds, she's stable, da, da, da. And then they go, well, why didn't they tell us about this loan over here, this car loan? Or why didn't they tell us about this private school fees over here? You said you didn't tell us that. Is there something else you're not telling us? Yeah. And you don't want that reputation against you as a client, but as well as your broker, especially if you're building a relationship, they know your situation really well. You don't want to damage that for obvious reasons. So it's better to be upfront, and they'll work through whatever the challenges are and be able to guide you through to say, we can't at this date, but we can by that date. And these are the things we need to get ready. And at least you work your strategy, get them in line and check in and go, by the way, just so you know, I did save that, or I did pay off that credit card, for example. Fantastic. Right, we've stepped where we need to be. Now we're about ready to go. That's all as simple as it can be. Yeah.
Good, because I would say about 30%. Oh no, that's probably a bit high. Maybe call it 20% of the clients that join our mentoring program to be coached, to build a portfolio, to create whatever they are that they're trying to achieve, be it income, retirement, whatever it is. I would say about 25% of those people may have a borrowing challenge or a servicing challenge where they don't service even right now. So they've come into the program, we've looked at their situation. You guys have analysed it every which way, and right now there's not a lever we can pull to get them lending. Now, it might be a 3-month challenge. It might be a 12-month challenge.
Yeah, correct.
I had one client that was not able to buy a property for 5 years because we had to sort out a whole raft of stuff for her, and she was a single mum on a single income. So but then she went on and she bought 3 in quick succession because we had a plan.
Yeah.
And I've actually interviewed her in another podcast. That's Lauren May. So you'll see her there. But it's all about having a plan and knowing your situation, because don't let somebody have told you, no, you can't borrow right now, be your story from here until eternity. It is not the case. It is just, correct. I don't borrow right now. What do I have to do to move forward? And what am I prepared to do to move forward? I mean, I've had clients move this was contentious. Moving with their parents so they could save better. I had, I've had people get a second job. We've had clients that have had 2 or 3 jobs for a short period of time in order to get the result they wanted and then knock it back. So there's a raft of options for people out there. So don't let, I can't do anything right now, stop you from getting in the, how can I say this? Don't let that get in the way of you creating your financial future, because the one thing that is guaranteed is change. And it's a good thing when it comes to finance most of the time.
There's probably no better time to make sure you've got a broker in your corner to navigate through all the nuances so you don't have to. And to leverage further what you said, Tab, there should be no such word as no. Replace it with not yet.
Yeah.
Just not yet. So if that's the case, that way there will be a solution. We've got to navigate which one we're closest to, what's most important, what are the pressures for that particular client with time, for example, what are we working with?
Yeah.
And then let's get to work. What does it need to happen? And like we said, even if you take a lender with a higher interest rate, but just for a short period of time, just to complete the scenario of accessing that opportunity, which might be at an amazing price and won't be at that price again, but you got it for a higher interest rate, doesn't mean you're going to have it for 30 years. It might be just for 1-2 years, maybe.
Yep.
And then suddenly
refinance out.
You've got your ducks in a row. I think the other thing too, Tab, with a lot of clients, which is unfortunately reality, is a lot of breakups and divorces, and then suddenly partners go, "Oh, what am I going to do now?"
Yeah,
it's not the end of the world either. The lenders are very familiar with this scenario, and that's again why I come with a broker and go, "Let's navigate and how we get that." Maybe single applicant now to work through what their scenario so they can get access to not only funds but property and continue a new journey.
Yeah,
it does exist. Our team are very familiar with it, and rather it not be, but glad they are.
Yeah.
So please don't ever accept no as the final answer. It might be a momentary point.
Yeah.
It's not yet is really the answer. So what do we need to do?
Perfect.
Yeah.
Well, I think that's a really good spot to probably wrap it up. I'll ask you my question that I ask everybody on a podcast.
Mm-hmm.
You could travel back in time, get into that little bubble and go back in time to when Scott was 20 years old. What advice would you have for Scott today?
Look, and I don't want to sound probably too obvious because the clientele you've got, but oh my God, wouldn't I have been buying any and everything I could, property-wise, wherever I could? I think I was living in Hunters Hill in Sydney at the time. I had an old 2-bedroom apartment there, which is a little balcony. It was about 100 metres to the water.
Yeah.
Yeah, wish I didn't sell that.
I was going to say, don't tell me you sold that.
Well, I had to because I was moving from Sydney to Melbourne to start my first business in Melbourne. So I needed capital. And anyway, but the short answer, the 20-year-old self would be, as I would tell my son, who's only 6, but absolutely get whatever property we can and start the journey as early as you can. And start diversifying revenue as early as you can. Because even if you did that for 10 years, that the difference that makes to your life and opportunity by the time you get to 30 compared to starting later in life is astronomically different. What was that, sorry?
Nothing. I was just 50.
Yes. So start early and don't be, you're trying to talk to myself and not be arrogant like you have to know it all. Just because you've studied this and you don't have to be the only person who knows things, talk to others who have done it, as many people as you can, use as much of that information, but the word is action. Just do. Don't put off today for tomorrow. Do it today. You will thank yourself when you're older. I probably lived a little bit too much for the day.
No, and it's a perfect note to end on, and it seems to be the theme. I think there's only 1 or 2 that I've interviewed that haven't said that same thing. It's...
They must have wealthy parents then.
What was that?
They must have had wealthy parents then, maybe.
Well, we can't go back in time, but we do get older. So jump in, get started today if you haven't started your journey. And I'm sure Scott, myself, and the team, if you're not already a client of Positive Real Estate, would love to assist. So I'll leave it there. Thank you, Scott, so much for your time today.
Pleasure, Tab. Thanks for the opportunity. Good luck, everyone. Have a good Christmas.
Bye for now.
Bye.
Hey, thanks for listening to Property Investor Tales. Remember to subscribe so you get notified every time a new episode drops. As you can guess, I love hearing people's property investor tales. So if you'd like to share yours, then please get in touch with me via email at propertyinvestortales@positivementor.com.au. We would also love your feedback, and I would appreciate a 5-star review over on Apple Podcasts or Spotify. Remember, you can watch all of these podcasts over on YouTube at Positive Mentor or at positivementor.com.au. Until then, take care, happy investing, and bye for now.